All right. Good morning, everybody, and welcome back to the Real Estate Radio Show. My name's Larry Shakman. I'm going to be your host and real estate therapist for the next about 45 minutes. We have a great guest we're going to bring on here shortly, Jake Clopton. And before we do, first of all, I just want to thank everybody for joining us again. Like I said, we have a great show lined up today. Got a lot going on in the real estate market out there between Fed rates dropping, mortgage rates dropping, or, at least staying steady right around 6%. And just a lot going on generally. As always, again, my name's Larry Shakman. I run a group of realtors out here in Chicago Metro at LPT Realty called Lux Group. And we primarily handle the Chicago metro area, even though we have a great lake house coming on the market in Indiana, which we are partnering with Joey Atkins over at Home Realty Group. And Joey's a great guy. This is a 6,000 plus square foot lake house, 7 bedrooms, 4 bathrooms on Kuntz Lake in Indiana. So that's Walkerton, Indiana, by the way. So that's about 2 hours outside of Chicago and about 2 hours from Fort Wayne. So if anybody's looking for a lake house, give us a call, 630-921-0611. Real quick, just want to thank last week's guest, John Hoffman he is the broker owner of Y Rent Real Estate and a big REO broker in the Chicago metro area. We talked a lot about foreclosures, what's going on in that market, what we think the future holds in that market, and maybe we can get into that a little bit with Jake as well. Yeah, so lots going on. We're going to get into some headlines as well. My partner, Michael Lafito, has a great property coming on the market in Wheaton, coming on for $979, 3,500 plus square feet, 6 bedrooms, 4 baths in Wheaton. Check it out. If you guys want information on any of these houses, by the way, that lake house is coming on the market at $899. So 6,000 square feet, 7 bedrooms, 4 baths, $899. So not bad. All right. Without any further ado, I want to bring on our guest because I have a lot I want to talk about with Jake Clopton. Jake is the founder of Clopton Capital and also Clopton Insurance, which primarily focuses on business insurance and commercial buildings. So we'll talk with Jake about that. We'll also talk with him about just what's going on in the commercial market and where he thinks that's all going. So without any further ado, let's bring Jake on and get right into it. Jake, how you doing? Jake, can you hear me? All right, Jake, I think is muted or can't hear me. We are going to get back with him in a second here and make sure that he can hear us. I'm going to let me just message him real quickly and make sure that he can hear us here. But what we want to talk with Jake about today is, first of all, what exactly is Clopton Capital? Who do they service? Who are their customers? And of course, they're located right here in Chicago Metro. And let me just get with Jake real quick here. Bear with me, folks. I'm going to make sure Jake can hear. Hey, Jake, are you with us? All right, so Jake is having, I think, Jake, are you muted? He might be muted. Let me see if we can. Get Jake back on here. Having a little technical difficulty. So let's see what we can do. Hey, Jake. All right, guys. So we're having a little bit of technical difficulty with Jake. I'm going to see if.
Larry, can you hear me now?
Oh, there we go. There we
There we
go.
go. Okay, finally. How you doing?
Awesome. Yeah, good. I'm glad we figured that all out. I don't know if that was on my end or your end.
I don't know. But we're
No
here now,
big deal.
so thanks for having me on. Appreciate it.
Yeah, glad to have you here. And like I was saying in our opening, I have a lot I want to talk to you about because, your
Okay.
companies are primarily involved in commercial real estate, commercial lending,
Yes.
and commercial insurance, correct?
Yeah, correct.
Okay, so you are going to have a really good, you're going to really tapped into that market in terms of what's going on, not only in the Chicago market, but you do business all over the country. So this is going to give
Yeah,
us,
we really don't market geographically. Like, we're really a nationwide firm. So even though we're based here, we're really nationwide.
yeah. And that is what interests me because, there's so much going on in the commercial market in large metropolitan areas. And there's a lot of, it's very fluid, right now. And I guess it depends on
Mhm.
which metropolitan area we're talking about. But before we get into it, give everybody a little background on Jake Clopton, Clopton Financial, who you work with, and that kind of stuff.
Yeah, absolutely. So I started this company 16 years ago. We were originally just a capital markets firm, so reconnect borrowers with capital sources. Since that time, we've added a few more verticals, like you mentioned. So we're also a insurance agency. We focus exclusively on commercial property. We're a real estate brokerage that just opened up this year. So we're helping people find property and list. We also do commercial and residential solar, and we're a 1031 qualified intermediary. So everything is, really comes from just having the database and clientele of commercial property owners and operators. And that's who we typically work with, right? So small to middle market, if we're talking about the capital market side, it's anything from like a couple $1 million and up in loan sizes. The average is probably somewhere in the 5 to 15 to 10 million bucks range, something like that. But we do some, much larger stuff. Like some of the largest deals I'm working on right now are like 150 million. All asset types nationwide.
Awesome. Yeah, so you would typically, what it sounds like is you would work with a very wide range of investors. You might be working with someone buying a 6 flat in the city, or you might be working with somebody that is buying a 300 unit 10-story building.
Oh yeah, absolutely. You're absolutely right. That's correct.
Yeah. So you've been in business since 2009. And what do you got going on right now? Anything in the city you want to talk about? Anything anywhere else in the country you want to talk about in terms of things? I know you're big. Well, go ahead. Get into that a little bit.
Yeah, I was going to say the stuff that we end up doing a lot of is really whatever's currently going on in like the market cycle, and also like whatever types of property private equity tends to be chasing, and people are kind of piling into. Like for instance, we're doing a ton of storage, right, and also a lot of car washes. It's just the latest property type that a lot of private equity firms are kind of piling into. But on a day to day, a lot of our volume also is just core property types, like multifamily. Still doing a little bit of office. I think there's actually a lot of opportunity there.
Wait, you think there's a
retail,
lot of
hotels,
opportunity
like
where?
that.
Where's it?
In office property.
Okay, because that's part of what I want to talk to you about with office space
Okay.
in the metropolitan areas, right? Um,
Yeah.
it's it's really in flux. You know, there's, yeah, not everybody came rush back to the office after the pandemic. So there's a lot of space available. And what do you see happening to that space in all these larger metropolitan areas that aren't filling back up with the tenants that previously had occupied them?
Right. Yeah. So, okay. Obviously, so office took a big hit because of the pandemic, right? Everybody had to go home. But it stayed that way because of, what I believe is that like dislocation in the labor market, where after the pandemic, you had twice as many job openings as you did people like workers. So all the power in the hiring process was really in the hands of the employee, right? I mean, they could demand to work at home and companies didn't really have an option. And I was saying this a few years ago that, once the labor market cools down and that power in the hiring process goes back to employers, I think you're going to see, them start demanding people come back to the office, which they are. I mean, look what Amazon just did a couple of days ago. Said everybody has to come back, right? And we're starting to see that more and more and more. And I think, and at the end of the day, I think the reason it stuck around was really just that, what was probably a temporary dislocation in the labor market, and the Fed certainly has cooled that down with raising rates astronomically, and now we're starting to see the economy cool off, and that's reversing a little bit. So I do think we hit the bottom in the economics of office assets, and there's probably a lot of opportunity in those types of deals, to do some really good value adds and to make a lot of money. Some of that office space though is just unusable, right? I mean, the C-class office buildings that are in CBD, stuff like that. Those two, you have to figure out something else to do with them. I've seen a lot of, the first thing everybody thinks of is just turn them into apartment buildings, but the floor plate plans are just a lot of, you really can't do that in the layout of a lot of office property, right? I mean, you can with some of it, and I'm seeing a lot of that done. And in like cities like Chicago, I mean, some of these cities are putting together like big incentive packages to try to repurpose this space. But I think there's some of that will happen, but others of these buildings, I don't know. Maybe they just need to get torn down and repurposed or something.
Yeah, I agree with you. A lot of these C buildings, they're going to be more difficult to get people back into because those people are probably never coming back again to those office spaces. But you brought up something that I was going to talk to you about anyway, and you're probably familiar with it because if I read correctly, you own several apartment complexes, correct?
Yeah, correct. In Chicago.
In Chicago. Okay. And what would you say in terms of unit numbers, what kind of unit numbers are we talking about with these complexes?
So we own a portfolio. They were all kind of on the smaller to mid-size scale. So anywhere from like 10 to 30 units total.
Okay.
We, over the last couple of years, and so I mentioned in the beginning, we're really expanding the verticals of what we're doing in-house at my company. And I try to not run too many races. So I've actually been divesting away from direct property ownership and really focusing on, building out the company further and expanding. It's hard to, what at least I believe was appropriately, asset manage all these properties around here and also be running like 6 different sides of this company, which is really my focus going forward. So, I'm paring down that portfolio a little bit.
Oh, okay. So my question is this though, because I wanted to bring up this program that Chicago has, and you kind of hinted at it. I'm not sure if it's the same program I'm talking about, but it's called not Chicago, but Illinois, Affordable Illinois. Are you familiar with that?
Vaguely, yes.
So Affordable Illinois is I don't know if it's a new program, but a newer program. And I'm gonna bring something up on the screen here real quick, if I can. But it's let me see if I can get this up here. It's a program where Illinois is offering landlords like yourself that own buildings that have 7 or more units in them really solid tax advantages to agree in return for fixing up the units, cosmetically, getting them, nice and everything, and keeping them affordable for 30 years. Now, it's only available to landlords that have buildings with 7 units or more in them. So, for instance, if I own a 3 flat or a 4 flat, I would not qualify for this. But someone like you who has a 10 unit or 30 unit would qualify for it. And from my understanding, the tax benefits really outweigh the that trade-off in updating the unit and keeping it affordable for the next 30 years. That's the trade-off. And supposedly there's a lot of landlords out there taking advantage of that with these larger properties.
Sure. I think in cities like Chicago, right, like you absolutely have to take advantage of the local government incentives. But there's no such thing as free money, right? There's going to be a lot of strings that come attached to that, which is why, I mean, I've candidly, I've stayed away from a lot of like the local government stuff around here because there are a lot of strings that come attached with it. Even Section 8 stuff. There's other programs, if anybody's in Chicago, the biggest programs that I personally took advantage of were, the local energy efficiency type of programs. Like, for instance, I bought 2 buildings that were kind of older. They were owner managed, kind of landlord at the time had been just, something would break. He would go in there and fix it temporarily until it broke again. Mm-hmm. There's incentives from, utility companies, other parts of the government here, where they'll go in and basically give you a ton of free efficiency upgrades. Replacing the boilers, the hot water tanks, the insulation, insulating the pipes, all this stuff. And I think there are 2 buildings in particular I'm thinking about. We got something almost like $500,000 worth of, energy efficiency upgrades. And that's a huge difference, on your expense side. So that's one of the programs that we did take advantage of pretty heavily. But I've tended to stay more towards like market rate type of rents and a little bit further away from some of the government mandated stuff.
Yeah. Yeah. I know, when I first heard that, I was like, agreeing to keep something affordable for the next 30 years. What does that mean? What's affordable?
Well, that's a subjective word. What's affordable? Yeah. So
that's the thing that was a little.
It would be difficult to, it'd be difficult to put a cap on your revenues, right? When that, maybe they freeze the property tax a little bit, but the other expenses around here are going up pretty heavily. And if you can't appropriately offset your expense load by, raising your rents to where it needs to be, I can see some people getting into trouble there. And if you're in one of those programs, the city's just going to say, okay, well, we're giving you a tax break. So deal with it.
There's one thing I left out that I need to add to that. So it's a percentage of the building. So in other words, if you have 10 units in a building, you wouldn't have to keep them all affordable. You'd have to keep 30% of them affordable is what I think the
right. It's still a pretty healthy chunk.
Yeah, still pretty healthy chunk. And, how do you raise the value of a commercial building, right? You can do that yourself just by raising the rents 10%, right? Right. I think not being able to do that, even with some, significant tax advantage, can get you into some murky waters down the road. But from what I've read, the people that have participated in this program, actually, they're saying it's working out pretty well for them. But, it's a long haul, 30 years.
It is a long haul. It is a long haul. Chicago has, a history of programs like this. There was some other, affordability programs where they keep the taxes really low to keep rents at a certain level. That that were around. One of my buildings was in those. I can't remember the exact name of it. That program went away because there was a mysterious fire sprinkler event in the office that held all of that paperwork, and all of it got destroyed.
My God. Are you kidding me?
Yeah. And that's at least the story. And then it was impossible to get back into it. So you got to understand my skepticism with some of the city's setup program.
When you start having fires and paperwork disappearing, yeah, you're going to start getting a little skeptical, right?
Yeah. I mean, I like the idea of having kind of like free range to appropriately manage your own properties, right? And also kind of keep, maybe not in so much other cities, but like especially a big city like Chicago that has a lot of local renter laws. You know what I mean? I mean, the other side of that coin is I guarantee you, and I don't know this program extremely well, but I guarantee you there's other strings attached, right? Like, can you evict people and this and that, right? I mean, it's hard enough to do that here as it is. I've had, I've had people stay in the units for over 12 months without being able to get them out. So, that's why, I like to keep a little bit more control over these properties.
Yeah, it makes sense. Once you let that control up in writing for like a 30-year period, I mean,
30 years seems like a long time.
It seems like a long time. Yeah, but that is the deal. That's what their plan is. So I guess like with a lot of the assets that you hold, whether they're 10-unit buildings or 30 or 40 unit, whatever they are, some of these are probably Section 8 or no? Are they all just straight market rent?
No, I've primarily stayed away from Section 8 type rents. I've had them in the past, and you do get higher rents, and this is, again, maybe not so much so in other markets. I've noticed that the managing those types of units, and then also like the repairs you tend to have to do afterwards, it kind of offset the advantage you get from it. We do have some Section 8 people, right? Like we've got some like senior citizens and stuff like that. And there's also like some Catholic charities around here that do, that can help people with their rent, stuff like that. So we have a couple of units, but what we do is primarily market rate.
Okay. Gotcha. Yeah, that makes sense. I mean, it's hard enough to manage these things, right? Without, getting into, I have to say, I know some people that do Section 8 and they don't really have any issues with it, but it is a different animal. And you have to meet different thresholds with Section 8.
It is. I think whenever you're taking advantage of a program like that, you really need to know what you're doing. Right?
Yeah.
And appropriately be able to manage that type of stuff. Absolutely.
Yeah. Now, do you guys, I'm going to guess that with the type of financing you do and the clients that you have, like, let's say I came to you and I said, hey, Jake, I came across this building. It's 6 units. It's in West Chicago. Here's the numbers. And, as with a DSCR loan, it supports itself. Do you do those kind of loans?
Yeah, absolutely. I mean, we'll do anything that is a loan amount, somewhere around like $2 million and up. That's where it really starts to make sense for what we do, right? And think of me like, this is what I tell people, think of me more like a service provider, right? So I bring in loan opportunities and effectively working for the borrower that's coming to us. And we take a very wide net cast approach to the capital markets for what we do. So any one deal that we bring in, I may talk to 300 different bankers on it, right? So that's really the advantage we bring to the table. I think, somebody that's out here and, looking just to arrange a loan on their own may talk to, 2 or 3 banks. Whereas, we're going to provide just a much more deeper breadth of lenders. And you think it just, because of what we're doing, we effectively are able to access a much deeper capital markets and get better rates and terms. That's for that's how I kind of position what we do for some of the smaller operators. For some of the bigger operators, like we are basically like an outsourced capital markets department. Mm-hmm. And we're effectively taking the time constraint off of their hands to help them, put together and acquire deals. So if you think about it, like these real estate companies, they've got like a couple acquisitions guys sitting there, and they have a buy box of stuff they have to get all over the country. And they'll use us to, model and put together their finance as well as insurance and stuff like that.
Okay. Interesting. Hey, we're going to take a 30-minute break, but I want to get your 30-second break, excuse me. But I want it when we come back, that'd be a long break. I want to get your thoughts on some of the headlines and some of the things that have happened even over the last week in the real estate market, and see what your thoughts are on that and where we're going. And we'll be right back in like 30 seconds, not minutes.
Welcome back to Real Estate Radio, sponsored in part by TrustedAgentUSA.com, the ultimate real estate matchmaker, saving you thousands. Now back to Larry, the real estate therapist.
Hey, so we're back with Jake Clopton, the owner and founder at Clopton Capital and Clopton Insurance. Jake, glad to have you with us. Really appreciate your insight on some of these things. Let's get into rates for a second, real quick, okay? So right now, 30-year fix, we're at about 6.1%. At FHA, VA, anywhere from 5.3 to 5.7, depending on what product you're getting. And 15-year fixed are also right around, I believe, 5.7, 5.75. What's your take on interest rates? Do you see them going down? What do you see happening with all this?
Yeah, absolutely. So when it comes to rates today, because of the environment we're in, it depends on which side of the yield curve you're talking about, right? Which is really interesting because the yield curve has been inverted, meaning like short-term rates were higher than long-term rates for so long. And now it's really flattened out. But when the Fed lowered rates by 50 basis points, I think one of the most important things to recognize is that they lowered short-term rates, right? The Fed funds rate. And that doesn't necessarily translate into long-term rates, like those indexes, like the 10-year, which a lot of the rates that you're quoting are based more on longer-term rates on treasuries than just the Fed funds rate. I think before the rate decrease on Wednesday, you had seen, treasuries really come down a lot. Right. I mean, now they're in the mid threes versus they were mid fours before. I don't know how much further that's going to go in the short term for a particular reason. So, and I used to trade interest rates, by the way. So I know a lot about stuff. When the Fed lowered rates by 50 basis points, right? They're, what they were doing effectively, individual mandate, right? It's inflation and, a healthy labor market. What they were doing is kind of taking, their eye off of inflation a little bit and focusing more on the labor market because, seeing the unemployment rate tick up, I think 4 quarters in a row, which, is not great. But inflation is still a little higher than I believe what they would want as a target, which is 2%. When they lowered rates by 50 basis points, something interesting happened, right? The Fed funds rate went down, but you saw longer term rates kind of tick up a little bit. So the 10-year rate actually rallied after they lowered rates. And I believe, and so the 10-year longer term rates tend to be more anchored to inflation expectations. And so when they brought down the short-term rates, I believe, the concept was that inflation will theoretically maybe remain more elevated than it would have if they hadn't. And so I'm not sure how much further those long-term rates are going to come down in the short term, but from what I see out in the marketplace, the real need is not necessarily long-term rates. It's the short end of the curve because, getting anything done with construction is incredibly difficult right now because all of your construction is going to be anchored towards short-term interest rates, right? So it's just interesting because it's so expensive, and and I think that's one thing that's really driving inflation in the housing market is because you've got supply constraint because it's so expensive to build anything. And real estate at the end of the day, as you know, Larry, is just a math problem, right? And
Oh yeah.
a lot of these deals,
Yeah.
the math just isn't mathing.
Yeah.
And that's where I think the real need is.
Yeah.
So I think, and we're supposed to get another 50 basis point decrease by the end of the year. So I think you very well could see the yield curve go from, earlier this year inverted to more of like a more natural upward sloping yield curve with longer short-term rates coming down healthy, but, those indexes kind of staying where they are, or maybe coming up a little bit because of inflation expectations.
Yeah, I agree with you in that I think where we're at right now, which is, let's just say around 6%. Okay. I think the interest rate fell and in anticipation of the Fed lowering their rate. And it's already kind of baked in there. So I agree with you. I don't see that coming down a lot in the next in the short term, as you said. But you never know for the
Right.
future. I'll tell you what, if they drop it another 50 basis points in December, I mean, that's aggressive. Wouldn't you agree?
It is aggressive. And I mean, don't get me wrong, the real estate market would use it, right? But the other side of the coin is, if the Fed is, that's an aggressive reduction. Even 50 basis points was aggressive. And if you listen to the conference afterwards, right, when Jerome Powell was speaking, he said, "Oh, we just lowered 50 basis points. Don't worry, we're not concerned, and everything is still healthy." I don't know how much I believe that, because that's a pretty aggressive drop, and that means that there is concern out there in the broader economy that they're worried about. And if they drop another 50 basis points aggressively by the end of the year, I think you're going to start to see, investor confidence out there come down a little bit, because it's more of like a canary in the coal mine, right? It's like there's a reason why they're reducing interest rates that quickly. And really, it kind of sounds like they're behind the curve a little bit and lowering rates, and they stayed elevated for too long, and something might be about to break. So I think that's the bigger concern.
I was surprised I was sure they were only going to drop it a quarter point. I was really surprised when they dropped it. Yeah, I was surprised when they dropped it 50 basis points. And man, if they do that again in December, that's I agree with you. I think that's kind of a canary in a gold mine. Like, why? We're at 2.5% annual inflation. Yes, the job market has cooled, but recently, like the most recent unemployment apps came back, and that actually fell. So, if those figures are correct. So it shows kind of like, the job market is still fairly resilient. We're not seeing wholesale layoffs across the board or anything like that.
Yeah, it is, but it is right now. Like, if you took a static picture of it right now, absolutely. But if you look at the trajectory of where things are going, that's where it starts to be a little concerning.
Yeah. Yeah. So last thing I want to cover with you before I let you go, and to enjoy your weekend, go golfing or sailing or something, whatever you're going to do.
Yeah, man.
So recently Zillow, there was an analysis by Zillow where it showed that, mortgage payments are now cheaper than rent in nearly half of all U.S. metro areas. And in 22 out of 50 of the largest metro areas, mortgage payments are cheaper than rent. And one of those areas, well, a couple of them, for instance, are Chicago, Philadelphia, Chicago, New Orleans, Pittsburgh, are showing, real value to people in terms of mortgage payments being less than rent. But then in other areas like Philadelphia, it's pretty much a wash on either one of those. So my question to you is, you own a lot of apartments in Chicago. with now that kind, for a while it was like more advantageous to rent than to buy
Sure.
because of high interest rates, high cost of, but now with interest rates coming down and some downward pressure on the cost of home ownership, now rents are becoming more expensive in Chicago than it is to own. How are you dealing with that as a business, as a man that owns, a lot of apartments?
Yeah. I'm always curious about that index, right? With just when they compare just mortgage payments to rent, and if they're really taking into account like the full cost of home ownership, right, versus renting. I think there's a lot of things you have to pay for that are not necessarily included in that mortgage payment.
Yeah.
Yeah. I mean,
No doubt.
there's no question rents here have really gone up a lot, right? I don't know currently what percentage, on the average it is of like the average, salary around Chicago, but I guarantee you it's a lot. And I think that again comes down back to the conversation we had before about construction costs and like, supply constraint. They just need more housing, right? And that's really what it comes down to. Is just the lack of housing supply that, people are able to get out there and build, which, now that rates are coming down, hopefully we're going to start to see a lot more construction starts and stuff like that. But, I mean, it is definitely a challenge. I haven't seen personally an uptick in, late rent payments or stuff, and, anything like that. I mean, hopefully it stays that way. We tend to be more in the workforce type housing sector, which I think is an area where, people can transition either upward into or downward into from like class A or like, class C type apartments. So I think that's a very resilient space. But I do think you're right. I think some of that like luxury apartment class A stuff, that's getting just really, really. I mean, I know people that are paying, as much for a 1-bedroom downtown as I pay for my mortgage. Right?
I saw a really nice 1-bedroom on the market on LSD right there, beautiful lake views, everything. 1-bedroom, nice, nice updated place, $3,200, not including the monthly HOA.
Yeah. No,
dude, that's more than I pay for my house in Naperville.
Yeah, no, I totally agree, man. I know. And I'm like, do you know how many times bigger my house is? But I mean, that's the thing. Like, it's like not everybody is ready for, home ownership, but yeah. I don't know. Believe me, I think about this very, quite often when I hear about like what people are paying downtown for rents and then like how taxed everything is in Chicago. I'm like, how it always kind of feels a little bit like a house of cards, but it kind of keeps working. I don't know how much further.
Isn't that crazy?
Yeah. I mean, look, Chicago is a great city, but Chicago's also not New York, right? I mean, the average salaries here are a little bit, I mean, they're good, right? But I think we're starting to approach very high rent levels. When I first moved here, something like 20 years ago, Chicago rents felt like one of the most affordable things anywhere, right? You had this huge kind of international metropolitan city and the rents were very affordable. And I mean, I'm starting to really date myself, but I had like a 2-bedroom for like $50.
Talking to me, Jake.
I know, man. But yeah, and it's just progressively, accelerated over the years. And you're not wrong. I don't know how much further it can go on because I think it's far outpacing like, the rise of wages.
It's crazy. Some of the rents I see are out there, but I don't know. It's all local, right? Real estate is all local. Some places rents are coming down, like in Austin. Some places rents are staying about the same. And in some places they're still going through the roof. So it really is just a matter of where you are.
I mean, those Sunbelt areas we do a lot of work in. And those, interesting enough, like a lot of these like Texas markets, San Antonio, places like that, that's where I'm seeing deals with actually some of the most like, trouble. Because in a lot of those areas, it's where people took on that really high leverage, variable interest rate type bridge money to do these value adds. And you're right. I mean, the rents stagnated and or coming down, and those expectations just aren't working out the way that they thought they were going to. And, the deals that they were doing were priced perfection. And, you think, because we've heard for so many years, like, oh, anything in Austin it's just got to be gold. But they took on a lot of these, syndicators took on so much debt. They're just really stuck in these things now.
Yeah.
So, I mean, those markets had huge run-ups. So they come down a little bit. They're still a lot higher than when they started, but you're not wrong. There's definitely some pain in those areas.
How about what's going on in the Florida market? Because Florida's shifting big time right now.
Yeah. I haven't really seen the same rent issues in Florida. What I'm seeing more in Florida, and this is just more insight from our insurance company, is the insurance aspect in Florida, right? The wind covers, and those policies are just skyrocketing.
Yeah.
I mean, I've seen, a policy in an apartment building go from like 20,000 to like 200,000. I mean, like overnight, right, on the renewal. And at the end of the day, I mean, that's real money. It's going to seriously impact your property values.
Oh,
that's the biggest problem I see.
Now, do you guys insure properties in Florida?
Oh, yeah, absolutely.
Because a lot of insurers have left Florida.
They have. A lot of insurers are leaving a lot of markets. And I think anybody who owns property today, I think the part of your P&L to really keep an eye on is the expense side, because the expenses are really getting out of hand, and insurance is one of those. And to not wait until, a week before your renewal to start looking, because a lot of these people are getting renewals, and, and like back in the day, you would just be like, oh, I'll get a 3% renewal and whatever. But now that they're doubling or tripling sometimes.
So what makes you guys stay in that market?
Left Florida. Well, I mean, we're an agency, right? So we're similar to the capital market side, where we can broker to, dozens of different insurance companies. But it's just one of those areas where I think people need, groups like ours the most. To help them like efficiently place the right policies.
Yeah, and that's right. You're more in commercial. What I'm seeing is a lot of homeowners in Florida. I just moved 2 people back to the Chicago metro area from Florida, just simply because, it's kind of out of control there with, like you said, especially for homeowners, residential insurance costs are insane. They're just crazy, and they're pricing.
Oh, yeah. All the residential stuff falls right into the same bucket with insurance companies. Yeah. So there's 2 things that are really affecting the insurance market. One is there's more losses, right? Just there's more weather, more climate, and I'm not here to debate climate change, but there just are. And the other side of that is, material costs and input costs are just astronomically higher. So the frequency of loss is higher, and the cost to fix it is much higher. And that just at the end of the day translates into higher policies. And, the whole idea of insurance, right, is spreading risk. So, if one area gets hit pretty bad, it's going to raise, all these ships. So it's just the entire industry is seeing it.
Yeah, one area gets hit bad and they sneeze, the rest, everybody else gets sick, right? Because somebody's paying for that.
Right. Right. It's like health insurance, right? I mean, the low risk pool has to offset the high risk pool.
Yeah, I call it death insurance, not health insurance. But you spoke earlier about, some of the challenges, and one of them was just supply side, not supply side, but just supply inventory. and that's what's keeping prices high, because building is so expensive. So the NAHB, National Association of Home Builders, just recently came out with a stat that they're a little more confident about the future. It went from like 39 to 41, so not some huge jump, but they're a little more confident, but they're still really bogged down, builders that is, by the cost of building. It's just it's it's keeping a lot of builders from building. We haven't built enough in the last 10 years, and we're still down about 2.8 million homes countrywide.
Yeah. I mean, the economics of housing is just still remains a great place to invest, just because the demographics, right, are so strong, and there's just such a lack of supply of housing. I mean, the idea being 2.6 or whatever million houses short. I mean, that's a big number. Like, where are all these people, right? But exactly. I mean, I've been hearing. But the crazy thing is, I have been hearing that statistic since I got into this industry, a decade and a half ago, and I don't know what the real long-term solution is to it necessarily. I mean, part of the problem is in a lot of these areas, it is really just hard to get local government approval to build anything. If some of these local governments would get out of the way, I think you'd build a lot faster. The other side is just cost of doing it. And now that rates are coming down, it'll get a little bit more affordable, but you're right. The other side is just, input costs, and it's just extremely high. Some of that is, the labor side. So hopefully that'll come down a little bit. But I mean, costs are certainly were rising higher than, or faster than, the values of some of these buildings. So that's tough.
Yeah. Hey, I appreciate you joining us today. This was a great conversation. We covered a lot. My last question to you, Jake, is: did you grow up a Mets fan?
A Mets fan?
Yeah.
I'm from upstate New York, in Rochester.
Oh, okay.
Not so much.
Because I was going to cut you off clean if you grew up a Mets fan.
Now that I'm here, we're going to go with the Cubs.
Well, they actually finished pretty strong this year. I have to say, I was pleasantly surprised. They're not getting in the playoffs, but they actually finished pretty strong. But the Mets basically, I'm older than you, but they basically ruined my life when I was 12 years old in 1969. And it goes back too far from you, but just look up the amazing Mets. And I've been in therapy since 1969 when I was 12.
Oh, man.
But listen, it was great having you on. If someone wants to get in touch with you, if there's an investor out there that, wants to get in touch with Clopton Capital, how do they get in touch with you?
I'm exceptionally easy to find. LinkedIn, Jake Clopton, or just call our company and ask for me. I'm more than happy to chat.
Awesome. All right, Jake, have a great weekend, and we'll talk to you again.
Likewise. Thanks so much.
All right. I'll see you. All right, everybody. That was Jake Clopton, the founder of Clopton Capital. What a great conversation. We're going to take a 30-second break, and we will be right back.
Welcome back to Real Estate Radio, sponsored in part by TrustedAgentUSA.com, the ultimate real estate matchmaker, saving you thousands. Now back to Larry, the real estate therapist.
All right, everybody, we are going to wrap it up for this Saturday, September 21st. I hope all of you guys have a great weekend. Get out there, have some fun. The summer's winding down. So, but we still got some good weather ahead of us. Last thing I wanted to cover with you guys, not all real estate agents are created equally. And one of the things that we do here at Lux Group, and what I do and our other agents do, is we put our active marketing plan and our active marketing, what we do, in writing. We want you to see exactly what we're going to do for you in terms of digital marketing, print marketing, and anything else we're going to do out of the box that's going to bring more eyes on your property when you first come on the market. So the thing that we do, a little different from some others, is we put our marketing plan in writing for you in this beautiful pamphlet, about 20 pages. It's going to speak to, like I said, our digital marketing, our direct mail, some of the text code marketing that we do. And one of the things we do that's unique is we'll actually put pictures of your house on the sign with the text code that will allow people to immediately get all the information they need about that particular property. So, drill it down when you're looking for a realtor. Find out what exactly is that agent going to do for you to get you the highest possible price in the shortest amount of time, keeping in mind that the longer you're on the market, the farther away you get from your list price. So keep that in mind when you're marketing your home. It's not always a good look to list it high because you can always come down. That's a good way to end up on the market and go through a lot of price adjustments, which is never a good look. So if you want a copy of our active marketing plan, give me a call, 630-921-0611, or you can just text us at 630-921-0611. Just say marketing plan, and I'm going to send you a digital copy of our marketing plan and how we're going to sell your house for top dollar in the shortest amount of time possible. We think out of the box here at Lux Group, and we'd love to show you how we do that. Having said that, you guys have a great weekend, and we will see you next week with another great guest on the real estate radio show. All right, see you guys. Have a great weekend.
Thanks for joining us on Real Estate Radio with your host, Larry Shakman, the real estate therapist and top producing broker. Now go to TrustedAgentUSA.com and save thousands when you sell, buy, or invest. Illinois license number 475-145-795. Tune in next week for the ultimate real estate radio experience. Thanks for joining